If you look at a stock market chart during a major panic, your brain naturally tells you a story of mass evacuation. Human psychology is built entirely on expectations versus reality. When the market drops 5% in a single day, the expectation is that everyone is rushing for the exits. But for every seller, there must be a buyer. While millions of ordinary investors are panic selling to protect their cash, massive institutional forces are quietly absorbing those shares. But why? It's easy to assume there is some grand conspiracy, some secret knowledge they possess that you don't. But the truth is much more fascinating and entirely legal. It comes down to a fundamental difference in how major institutions view time, liquidity, and fear. Why do the biggest pools of capital in the world run into the fire while everyone else runs away? Let's find out. To understand why institutions behave differently during a crisis, we first have to shatter the biggest myth in modern finance. When people hear the name BlackRock, they imagine a shadowy cabal of executives sitting in a boardroom, using a limitless corporate credit card to buy up all the world's stocks and single-family homes. Let me bring reality crashing back down. As of 2026, BlackRock sits on a staggering $14 trillion in assets under management, or AUM. But that $14 trillion does not belong to BlackRock, the corporation. They do not personally own the companies in their portfolios. BlackRock is an asset manager. They operate like a giant financial plumbing system. The money actually belongs to public pension funds, university endowments, insurance companies, and ordinary individuals holding an ETF in their retirement account. When you see a headline screaming, BlackRock is buying, it usually just means that capital is flowing into their funds from clients, and their algorithms are legally obligated to purchase the underlying assets. But this raises an immediate, glaring question. If BlackRock is just managing money for other institutions and investors, why aren't those clients panicking and pulling their money out when the market crashes? The anatomy of fear. To answer that, we have to look at the structural difference between a retail investor and an institutional client. When an ordinary person invests, their money is intimately tied to their immediate reality. A retail investor might need to pay a mortgage next month. They might be worried about losing their job. When the news announces a looming recession, retail investors suffer from what behavioral economists call liquidity panic. When retail investors feel fear, they demand cash. They sell their holdings, regardless of the underlying value of the asset, simply to secure a safety net. But institutional capital operates on a timeline that the human brain struggles to comprehend. They don't react to headlines because their survival doesn't depend on next month's cash flow. But if institutional investors aren't panicking, how exactly are they looking at the market when everything is in free fall? The institutional time horizon. A state pension fund or a sovereign wealth fund doesn't care what the stock market does this Tuesday. Their liabilities, the payouts they owe to retiring teachers or firefighters decades from now, are stretched over 30, 40, or 50 years. This creates a massive arbitrage opportunity based on time. When a geopolitical shock hits the news cycle, ordinary people dump their shares to avoid a short-term loss. But an institutional portfolio manager, supported by advanced risk management infrastructure like BlackRock's proprietary Aladdin system, looks at the exact same drop and doesn't see a crisis. They see a valuation disconnect. If a company's long-term earnings potential hasn't changed, but its stock price just dropped 10% because of retail panic, the institution will gladly step in and buy. But wait, if it's so obvious that buying the dip works, why do ordinary people consistently fail to do it, even when they know the math? The private market shield. It boils down to liquidity constraints and asset exposure. You would think that an ordinary investor could just adopt the mindset of a multi-billion-dollar endowment fund, but you cannot survive a market crash if you need your money to live. Furthermore, institutions look at asset allocation entirely differently. According to the 2026 BlackRock Private Markets Outlook, institutional investors are aggressively shifting toward a whole portfolio approach that blends public equities with private assets like infrastructure and private credit. In fact, many are moving toward portfolios where private assets make up as much as 20% of their total allocation. Why does this matter during a panic? Because private markets are illiquid. They aren't traded second by second on an emotional public exchange. They don't have a giant red flashing sell button. Because a significant portion of institutional wealth is locked up in these private infrastructure projects and long-term credit facilities, the managers are structurally protected from their own fear. They can maintain absolute stability in their private portfolio, allowing them to calmly deploy their liquid cash into the panicked, discounted public markets. But what about the funds that are strictly public? What happens to the standard index funds when everyone panics? The emotionless machine. This is where the automated, emotionless machine of modern finance takes over. BlackRock's iShares division is the dominant force in the global exchange-traded fund market. In 2025 alone, BlackRock hauled in a historic $698 billion in full-year net inflows, a momentum that carried directly into 2026, with billions more pouring in every quarter. Think about how an index fund actually works. Every 2 weeks, millions of workers around the world receive their paychecks. Before that money ever hits their bank accounts, a percentage is automatically deducted and deposited into their retirement plans or automated investment portfolios. That money goes straight into index funds managed by firms like BlackRock, Vanguard, or Fidelity. The algorithms running these funds don't read the news. They don't care about inflation, interest rates, or political instability. The fund's prospectus legally obligates them to take that incoming cash and immediately buy the underlying stocks to match the index. When retail day traders are screaming on social media to liquidate everything, the automated paychecks of the global workforce are forcing the index machine to buy billions of dollars of equities every single day. They are the ultimate buyers of last resort. But this brings us to a critical warning. If the machines and the institutions are buying, shouldn't you just follow them? The chaos trap. Why you can't copy them. At this point, your expectation is probably that you should just track what major institutional asset managers are buying and blindly replicate their trades. Let me bring reality crashing back down. If it were that easy, every retail trader would be a millionaire. The truth is, the financial world is littered with the investment accounts of people who tried to play institutional games with a retail bank account. And the reason they fail is what we call the chaos trap. Most beginners try to mimic an institutional investment strategy without understanding the underlying math. They see a regulatory filing showing a major fund took a massive position in a distressed asset or a volatile tech sector. So, the retail investor dumps their life savings into it. But what the headline doesn't tell you is that the institution only allocated 0.5% of its multi-billion-dollar portfolio to that trade. They also bought derivatives to completely hedge the downside risk, and they plan to hold it for 12 years. When the asset drops another 20% the following month, the retail investor panics and sells at a massive loss. The institution, they just view the drop as a rebalancing opportunity or a tax loss harvest. You are playing a completely different game, on a completely different board, with completely different rules. So, let's zoom out and look at the big picture. We started this video wondering why behemoths like BlackRock seem to buy everything while the rest of the world panics. For years, popular culture has assumed this was due to secret corporate plots or market manipulation. But the reality is far more structural. The institutional advantage is not built on secret information. It is built on structural discipline, multi-decade time horizons, systematic automation, and the intentional use of illiquidity to protect managers from human emotion. When the cost of executing trades drops to near zero, the premium shifts entirely to emotional control, liquidity management, and patience. And in those categories, an automated index fund or a heavily insulated pension plan will win the long game every single time. The lesson here isn't that you should fear giant asset managers or blindly copy their trades. The lesson is that fear and panic are expensive luxuries that only unprepared investors indulge in. The barrier to entry in the global financial markets has never been lower, but the barrier to emotional discipline has never been higher. The tools are available to everyone. The only question is, are you going to let short-term fear dictate your actions, or are you going to learn to think like the machine? Thanks for watching. See you in the next one.